No one likes math.
Quite frankly, it's flat out confusing.
If you are a straight salaried person, I'm sorry, right? We have to pay the tax rate that we have to pay.
I'm teasing. Okay, here we go. I'm just a few years off from retirement.
I think my tax strategy is off because I always seem to owe more than I think I'm going to.
What are some of the things I can do to make sure I reduce my overall tax burden throughout the year while keeping my tax bill low in April? Lowering your tax burden really always depends on what deductions you can take. A lot of clients seem to think that they are always paying more taxes than they should. In some cases, yes. In most cases, no. Because if you are a single person with one house, no children, maxing out your 401k, for the most part, unless you're doing some charitable givings or something like that, there's not really a way for you to reduce your tax burden. So I just want to tell people that to be careful down the internet rabbit holes of how to be tax efficient, because most of the time there isn't a way for you are being as tax efficient as you can.
So I get this one off, especially over the last 3 years. They've changed the rules, and I think what happened is, I think a lot of people are under withholding from their paychecks. Tax burden going up and owing are two different things. So sometimes if you talk to your CPA, we can go, maybe you just need to withhold a little bit more so you're not writing one big check at the end of the year. So if you're on a 26 pay cycle, $50 every 2 weeks hurts a whole lot less than one big $5,000 check.
Big mistake is to just start thinking about managing taxes when you're filing your return. The first thing I would think of is maximizing your 401k. If you're putting in the full amount that you can contribute to your plan, that is a big deduction that you can get against your income.
Because a lot of times people forget that the most they're allowed to do is a fixed number, not a percentage. Because a lot of times they see their employer does a 4% match, so they think their max is 4%. The 401k max is $23,500, and then you get a catch up of $7,500. So that's another $31,000 potentially that you can reduce from your taxable income.
In addition, if you're eligible, you can explore doing a deductible IRA. It's also a deduction that you can take. And if you're beyond the threshold, meaning you make too much money, you can explore doing a Roth IRA. Now, that's not going to save you in terms of taxes today, but that does potentially save you on taxes in the future. If you have a high deductible health plan through work, contribute to a health savings account. You might see HSA when you're looking through your HR information. Health savings account is fantastic. When you contribute money into the account, you're getting a tax break. The money grows tax deferred, and ultimately when you use it for qualified medical expenses, the money comes out tax free. So this is a fantastic vehicle.
Make sure that you are maxing out on your 401k or 403b or any retirement plan that's available to you at work. So that way, you can save that on a tax deferred basis if that aligns with your overall financial plan.
A big part of maneuvering through tax situations is getting professional guidance. Having a CPA in your corner or having a financial planner that can help you with tax planning. You need people in your corner because the tax code is incredibly complicated. There are lots of financial advisors out there, financial planners, plenty of great people to engage with, get advice from, seek professional help from, because this stuff can get very confusing very quickly.
No one likes math, right? And this goes from my experience. This was in 3rd grade when they went to fractions, you got lost and then you lost the building blocks to get there. Whenever I'm talking to anyone, I try to get a sense on who they were before they came to my office, right? Did their parent tell them, I always buried money in the backyard? All right, I gotta do something different. If I have someone's like, pay off your mortgage fast, right? I try to understand who they are so I can understand where they're coming from and educate them where they feel comfortable, right? And it's the dialogue, it's the conversation, it's feeling okay asking the why question. Why do you think that? Why is that? Why? That's the fun part about the job.
I am about to enter retirement, but I've never fully understood the best way to withdraw from my 401k/other investment accounts.
I have a 401k, a traditional IRA, and a brokerage account.
Which should I withdraw from first in order to reduce my tax burden and make the most of my money?
That's a great question. Many people have accumulated many different types of investment accounts that can be taxed in many different ways, right? So sometimes we're looking at somebody who has an IRA and a taxable account and a Roth IRA, and there could be a variety of other accounts, and you're trying to figure out, how do I approach this to manage my tax burden? There are different approaches, and like any approach, they all have pros and cons.
Well, congratulations. You have what we call many legs to the stool, right? Making sure that you have a good mix of taxable, money, pre-tax money, maybe Roth or money as well, just makes it a lot easier for us to build a tax-efficient distribution strategy, right?
This question is a little bit loaded, and here's why. I could say very simply, well, the most efficient thing is to leave your tax-deferred accounts like your 401k and IRA, until you're at required minimum distribution age. So either 73 or maybe as old as 75, depending on when you were born. And in the meantime, spend down your brokerage account, because that way you're leaving the tax-deferred accounts to grow for as long as possible. You're deferring all those taxes and you're pushing them out until later. But that may not be the right answer for everyone, because this is yet another one of those questions where my answer is, it depends.
If the goal is no taxes, ultimately you're looking at an account that's not growing. So what I try to educate people on is, think about the three different buckets. We have a pre-tax bucket, that's your traditional IRA or 401k. We have an after-tax bucket, that is your Roth, and then we have a taxable account, that's your brokerage account. If we can find ways to put money in each of those each and every year, if we can magically get a third of your accounts in all of those, we have an easier drawdown strategy in the future, because the beauty is, like the Roth is one of my favorite wealth transfer accounts you have, because it doesn't have any required minimum distributions. So in theory, that should be the last account you ever touch, so it should grow the most. So if we can find that sweet spot of brokerage account and traditional IRA account to minimize taxes, we can create a withdrawal strategy that works well in your lifetime, but also sets up your heirs to hopefully get some tax efficient money from the brokerage account or the Roth account.
Rule of thumb is you always withdraw from the monies you've already paid taxes on first, and then move on to the money that you have not paid taxes on, so the tax deferred money, and then finish with your Roth or after-tax monies. And the simple reason for this is that you will allow your Roth money to grow for the longest period of time, because once you retire and you take money out of that account, you don't have a tax burden. And if we have a progressive tax that may continue to go up, now you have a bucket that may be taxed a little bit less. So for most people, that strategy would work.
One approach is to take a look at all of the accounts that you have and just take proportionately from each account. So if you've got half your money in a Roth IRA, half your money in a traditional IRA, you take half from both. The mindset there in many circumstances is that I have this predictable tax situation from year to year, right? I'm not heavily leaning one way or another. So I think there's an element of predictability for some people there. There are also individuals that'll take a different approach, right? They will strictly focus right on the retirement accounts to spin them down first. Now, they might cause a larger tax bill today, but there could be reasons for that, right? So for people that know they're going to take their required minimum distribution at some point, here's a secret, that's all of you. If you have an IRA and you eventually reach age 73, you might find yourself in a position that you are required to take a certain amount out of the account, right? This is a law that says you have to take out a certain amount of money. And for some people, it's a substantial figure. And so you might be looking out 5 years from now saying to yourself, I'm going to be required to take a substantial amount of money out of my retirement account. Quite frankly, money I don't need in the future. Let me try to get ahead of that now. Let me start spending down this balance to some extent now and essentially spread out the tax burden over the course of many years.
Yeah, I mean, if your goals are really heavy on distributions in the first few years of retirement, absolutely it is going to change your distribution strategy throughout retirement. Because let's say, you need to buy a house right when you retire, you're keeping your current house. I had a client who actually what they were doing was they wanted to stay in their house while they build a new house, move into that new house before they sell the other house, right? So eventually the money will flow back into the funds that they will have. But in the meantime, we have a real need of a few $100,000 in order to build that new house. So the cheapest way tax-wise you could do this is to go into your brokerage account and make those distributions, right? Now we have to figure out what capital gains means in the first few years of retirement. Now we have to figure out while they move into the new house, maybe the other house takes a longer time to sell. We are now hitting those accounts that may be pre-tax. So what is the tax implication of that? And for every plan that you do, you have to make sure that your clients can afford the taxes that they're gonna owe on those distributions, right? So again, your distribution strategy, especially if you are really focused on having a tax-efficient distribution strategy, which everybody should, has to depend on those goals that you have to meet in those first few years of retirement.
When you are taking, withdrawals off of your portfolio, you're not just thinking about just straight taxes. You also have to think about Medicare premiums. You also have to think about what are my taxes today versus what might my taxes be when I am 73 or 75 and over. Because if you leave your retirement accounts to grow for another 10 years, well, using the rule of 72 at 7+% return, those assets have theoretically doubled. And so now your required minimum distribution is based on twice the amount of money you have now. Well, what is that going to do to your tax rates later? So there is a lot that needs to be looked at here before we can say what's the best place to draw from. And from one year to the next, it might actually be different.
We can find, let's call it the minimization with paying some taxes now to hopefully pay less tax in the future, because really the Secure Act 2.0 has really changed the dynamic for a lot of clients, because they've now moved the RMD age even further, which means you have even more years to compound your 401k, which more than likely, when you're 73 or 75, you may be forced to take out a higher amount of your IRA than you even need, which creates excessive taxes. So by having this drawdown strategy conversation early, you may be able to pay slightly more taxes today to avoid paying much bigger taxes in the future.
There's another approach you can take as well. For some people, they just want to minimize taxes today, and they'll completely ignore their retirement accounts, specifically IRAs and 401ks, and they will spend from their taxable accounts, right? These are non-retirement accounts. Think of your joint account with your spouse or trust account, right? These are examples. Generally speaking, you will have less of a tax bill today. So if your goal is to reduce your taxes today, that might be an approach that you would take there.
There might be opportunities for you to think about tax efficiency, not just now, but over the rest of your life by doing things like Roth conversions in years where you have a smaller amount of income, right? Let's say you're just turning 60, you've retired, and you don't really have much by way of income and you're planning on living off of your assets. Well, you might consider doing some Roth conversions with your 401k or your IRA and pay taxes now at that lower rate versus waiting until later. There's a lot of math that needs to be done to figure out what's the right way to do that. That's what a planner can help with. That's what we help our clients with all the time in our financial planning process, is to help them determine what do you take from and when, and which account and how do you facilitate that? So
we don't preempt the tax code because you don't know what's going to come out of Washington, right? But once the code is in place, we rerun that tax efficient distribution strategy to see if it's going to change what we were already doing. Whether it is the brackets are wider, which means that we can do more Roth conversions, for example. A recent case of mine is clients who had kids later on in life, so now college expenses are coming into play a couple of years after they retire. So we have to probably pump the brakes a little bit on those Roth conversions, because now they're going to need more income to cover college expenses for the kids. So really, it is a contact sport, having a tax efficient distribution strategy.
Taxes are incredibly complicated, and to make things even worse, the tax codes basically change every year. You know, I have kind of lost track, right? This is what I do for a living, but I will tell you that I keep a spreadsheet. I keep all the numbers right next to me because from one year to the next, the numbers are all different. The tax rates might be different. The cost of living adjustment on one thing versus another are different. So it is incredibly complicated. And what that means is that you've really got to stay on top of this stuff, right? You need to be working with an expert because there is no way that everybody could keep up with the level of complexity that our tax code gives us.
Every approach has its pros and cons. The reality is this can get very complicated rather quickly, and so this is something you should seek professional advice for. Talk to a planner if you don't have one. Figure out what the best approach is for you, because it is going to be based on your age, what your expenses look like, what do we have in all these various accounts, what do the balances look like, and that's going to help us come up with the best strategy to address your situation.
If you don't have a financial planner, get one. Because a lot of people think that they need to set up a tax-efficient strategy in the beginning of retirement, and that's just what they ride. When we all know there are changes to the tax code on an ongoing basis. So checking in on your distribution strategy on a continuous basis is going to be really what's going to save you the most money on taxes, because as laws change, as little quirks here and there change, you can adapt to that and then figure out again which account should I hit at what time.